want to discuss the Google Employee Trading Plan or program. Let me see.
Great. And I want to talk about how do you account for, or how do you minimize, how do you manage geopolitical risk?
Does Bitcoin fix this, or what's your answer?
I think of three kind of ways of fixing this. One is prediction. You can predict the outcome, but obviously you can be wrong. But if you predict the outcome, you can minimize the risk by trying to understand what are the implications of that. The second one is finding protection, and so maybe buying insurance or going into there's different ways of protection. Credit default swaps, but that's not for the retail investor. There's different ways, and then the final one is ignoration.
Ignoration.
Ignoration, yeah, it is truly ignoring the events. Long term, the invasion, the annexation of Crimea barely had any effects. These small flare-ups in conflicts around the world on the long run do not affect your portfolio in a way that is probably noticeable. Some say even wars are good for the portfolio. I still prefer to make money the old traditional way in peacetime. But I think the one thing is if you think that geopolitical risks are going to rise, there's an obvious question: what happens to the defense budget? And then once you answer that question, you can start to understand what the ramifications are. The other thing is, like, let's say in this case, Russia invades Ukraine. What are the ramifications there? Specifically, if you own Russian stocks. So I think the answer is pretty evident that there could be a volatility in those stocks. There could be downright issues with the U.S. suspending. There's been talk about them, sidelining them from the SWIFT, basically the global way of moving money through the banking system. So sidelining them from that would be catastrophic for their ability to do trade. And so as a result, there's specifically a couple of banks in Russia. If they're taken out from the SWIFT system, then that would be really bad. So that's a risk. There's a lot of other things you have to think about. But the big question is, can a country of 44 million be invaded by a 146 million person country? That's a 30% of the population. So it's, I think it's a difficult thing to see, but it would be akin to America invading Mexico, and I think that's a very difficult proposition to control in the long run. It's a big country. There's a lot of people. Some of them are going to be sympathetic to the Russians, specifically in the Russian territory, but a large chunk of it won't be. I don't think, if anything, it would be a short endeavor. They go in, they take over the capital, they install a puppet governor, and that's basically, or puppet president, and that's it. That's my perception. And then they exit, and everything returns to normal from that side. And then there's some sort of negotiated agreement. Very popular way of approaching, it's not the best, the very popular approach of approaching these geopolitical risks is completely ignoring them and going on with your life. As I would say 99% of everybody in this world does.
You think so? I don't think it's that high. So, all right. Sorry, from the beginning. Predict, which has its own complexities. Hedge or protect, which maybe there's an opportunity cost.
I think hedge and protect are kind of the same.
Right. That's what I mean. Hedge or protect. Protect to keep the P's going. We'll call it protect. And then the third one is ignore or do nothing or don't react. I think a subset of the third one is to, like, you can ignore from a portfolio perspective. You can choose. I don't mean ignore. You can engage informationally with what's going on, learn, pay attention, but elect to not make any actual changes based on that information. On any given geopolitical thing, I don't think that it's my job as an investment manager to stay up to date on war news, for example. Not because I'm trying to ignore the risk, because I'm accepting it as part of the broader equity risk premium.
I think you can do a good job predicting certain things. The problem is like when you reach third order or second order effects, you can probably, let's say you predict the event, right? First order effects are pretty easy. Second order is a little bit complicated because you actually need to kind of predict the response as well. And then there's a feedback loop, right? So the third order effect is pretty much, to me, it's extremely hard to get. You might even get the events right, but the effect on the market's wrong. I just described to you like what I think might happen first of all, I don't think they're going to invade, but if they do, what they will do is they just go in, install Puppet, markets continue, Americans and Europeans apply sanctions, no more gas to Germany, doesn't open up Nord Stream 2, and they embargo certain things, or they sanction certain companies, whatever, and politicians and stuff like that. Trade diminishes, and certain sectors where the West needs their imports, they'll still allow, but the other ones where they can get a competing provider, they'll ban. We'll be back and forth for a couple of years, and then the things will return to more normal.
Okay, so predict versus number 3, which is accept or ignore, depending on how nice you're feeling about the interpretation. What do you think about those two approaches for geopolitics in portfolios?
If your portfolio is mostly American or Western European, and it doesn't really have it, it wouldn't have an impact. If it isn't commodity based, if it isn't like a bunch of things, then you might not need any insurance. But if you actually are invested in Russian stocks, in banking stocks, then you need to understand what the consequences are. So it depends really what your exposure is from the beginning.
If a country in which you have equities is going to war, as an investor, you need to know about it?
Yes, obviously. That's the real answer is yes.
I disagree. I totally disagree. I think you can invest in VT, the total equity market Vanguard ETF that has exposure in a ton of countries, and safely not be reacting to news about war, for example, even though you own stocks that have headquarters in Kiev and Moscow and St. Petersburg or other places where war can happen.
But what's the exposure then? How much exposure to Russia would you have if you have the VTI? I wonder that. Russia, 0.3.
There you go.
Yeah, I mean, nothing practically. It's probably less than the daily volatility, right?
Probably less than daily volatility, true. But if you own, for example, a popular emerging markets ETF, let's see, I'm going to go to IEMG on the iShares website and see if I can find.
I think the elephant in the room is really, it's not so much, Ukraine. It's more like, I would say, Taiwan and China, right? What do you do there? So together, those represent like 5.5%. So China's a big country and they'll do fine probably. But the question is what the response is. I don't know.
In IEMG, the Russian Federation, as they call it, is just over 3%. China, 29, Taiwan, 16.6. So those together are like 45, 46% of an emerging markets index fund.
That would get me worried, right? So if you have those two conflicts together.
Fair enough. All right, so 1 through 3, where should people rank themselves? What should people be thinking about?
I think it's an individual choice, right? Again, as everything it is, mm-hmm. It's just trying to figure out what suits you the best based on your personal situation. Again, we're not giving advice, right? Like every advice should be customized to someone's situation. So
I'm partial to number 3 of what you went with. I think that number 1 will I think most investors will not be well served in trying to predict it. I think markets have a lot more information than any one person can come up with themselves.
Yeah.
So I think you run the risk of tricking yourself into thinking you're smarter than you are with number one. I think number two is a must do, but it's part of an asset allocation discussion. Like you must face those risks. I don't mean that you must hedge or you must, not own equities or anything like that. I just mean that geopolitical risk and exposure, like that's in the prospectus of the fund. Like name an equity fund, I guarantee that's in there as a risk, right? This is part of the equity risk premium, I think. And then number three, ignore is one thing. I think happily accept the risk and accept the prices that the market will give you, I think is good. So I'm partial to 2 and 3 for sure.
Let's talk about your topic.
Let's do it, man. I don't think you and I have covered this, and I think this program has been around for a little while, but if you're a Google employee and you receive GSUs, Google's adorable moniker for their RSUs, restricted stock units, they call them GSUs instead of RSUs. You've probably received an email from HR about the ETP, the Employee Trading Program. And Google is in the scope of all employers that give equity compensation and, provide 401ks and all the financial things that companies can give you. Google is like, they just give you so much. Like so many of the little things just work well. Their 401ks at Vanguard, it's fantastic. They give you 2 options as to where you'd like to house your equity comp. You could use Morgan Stanley or Schwab. They're really forward thinking, and HR is always using tech to make things easier. But the upshot of this is that Google has a really nice, almost entirely electronic process for you to opt into auto selling of your unvested RSUs at the time in which they vest. And the other good piece about this is that it conforms to Rule 10b5-1, which is an SEC kind of structured type of plan in which you can.
But the effect on this, while you look it up, the effect on this is that you're allowed to sell during closed windows, correct?
That is exactly right.
And so you're able to get a more like an average price over the year.
Correct. You are not subject to the blackout periods pre-earnings because you have already elected before having knowledge or before those periods even started that you're going to sell these shares over this period. Oh, the term is affirmative defense. You are setting up affirmative defense against insider trading. What that means is that you are following the rules, guidelines set by the SEC to preemptively avoid any allegations of insider trading, which is of course helpful. No one wants insider trading. Please don't do it. It's, illegal. Google is one of the only companies that I've seen that is offering employees easy, online, automated 10b5-1 trading plans for RSUs. I'm a big fan of this. If you're a Google employee and you haven't thought about this or looked into it, the window for electing it for this next year closes Friday, February 18th. That's probably, this video will not be out by that point. But regardless, look at it next year. It's an opt-in program where every year you have to opt back in. It's not going to, it's not an auto sell that just continues forever, which is characteristic of 10b5-1 plans. You generally don't set one, for the life of your employment. A year is a common time frame for those. But yeah, I don't have that much else to add about it. It's just a great program. They're using tech in a smart way. They're using kind of the compliance features that are really important. And Google is just continues to deliver on the HR, finance, kind of employee experience side in a way it's a great place. It's like unsurprisingly a great place to work. So.
Yeah, I think it's just forward looking. It's so much, all the things that we, I would say planning opportunities that might arise that in an ideal world, I feel like they are getting closer and closer to that.
Yeah. They're helping to get you to these decisions faster. And I want to we've said this before on this program, but I'll say it again. With RSUs of a public company, if you're receiving RSUs and you choose to not sell them as they become vested, there is not it is functionally equivalent to you receiving a portion of your cash compensation and buying your company stock with it. So if that's 10% or 30% or 40% of your total comp, that's just like you going out and buying the stock. I think there's a common misconception where I've heard a lot of people say this and say, no, I'm going to wait for long-term capital gains on my RSUs. And without understanding that all they're opting in for is for price risk, which is okay. You can opt into price risk, and I understand that. But if you cut off the price risk at the time of vesting, you have just a different risk profile than you would otherwise.
Completely agree. It's not hard once you understand what the order of operations is, that it makes it much easier. Like, you get money, it's taxed. Now the stocks appear, and now the clock starts ticking. And you have two options here: keep the stock or sell it and incur. In many cases, if it vests and you sell it the day it vests in the open market, you likely have no extra taxes apart from
slippage,
compensation income.
You'll have some slippage from that day. I've seen people with big compensation packages end up with a serious amount of difference on their 1099 because they own a volatile stock and they got RSUs and they sold same day, but there's still difference in the grant price and the sale price. But you can minimize that by minimizing the time of exposure there. So always think about that with your RSUs.
But that program from Google eliminates that, because if you have vesting during a closed window,
it partially eliminates it so that the execution is actually on the ETP, at least on the Schwab side, depending on the lot and the grant that it comes from, they have a couple different opportunities for how it can be sold. Most of them are going to be executed on the day that they can be sold, as at the volume weighted average price is what they will give you in the 10b5-1 plan. So you're not going to get the best price of the day. No one is going to guarantee you that they can give you that. They're going to get best execution that they're able to get through their brokerage firm, which you got to understand that Google's going to do their best to get you good execution, but they can't perfectly maximize that for you, nor can anyone.
Yeah. Are you aware of any other good things from a planning perspective that is allowed with Google? I haven't worked with a lot of people from Google, but I have with Facebook and obviously Coinbase.
Two great things about Google. One, the technology on their 401k plan is fantastic. So for example, if you have an old 401k and you'd like to consolidate it in your Google 401k through Vanguard, it's very easy to do that. They automate the roll-in process, which I found in many other plans is a nightmare, really hard to do. That's one. The other one is the Mega Backdoor Roth is super easy to do, and it has a daily in-plan Roth conversion feature. So it's not letting any compounding time go by. It's literally sweeping your after-tax account daily. So Google's 401k plan is absolutely fantastic.